We think there are three reasons investors should consider adding private equity to their portfolios. First, private equity has outperformed public stocks over long periods of time. For example, private equity has outperformed large cap stocks like the S&P 500 by 3% per year, and small cap stocks that we think are a more appropriate index, like the Russell 2000, by nearly 5% per year over the last 15 years. Second, private equity is an important part of the overall equity market. Over the last 25 years, there are actually 40% fewer public companies to invest in. At the same time, private equity has grown in importance as an option for business owners and entrepreneurs to be backed by private equity firms. So we see private equity as an important differentiator in a client's portfolio. Third, private equity is an important diversifier for a client's portfolio. So for example, private equity derives its returns from a different source than public stocks or bonds. So we think the addition of private equity to a portfolio can increase the portfolio's return and dampen down risk. My team is using both a top-down portfolio construction and bottom-up manager selection to build private equity portfolios. The top-down portfolio construction consists of choosing types of private equity, like secondary funds that buy interest in mature assets, primary funds that buy newly established funds that are more likely to deliver upside, and co-investments. Secondly, the team is choosing among private equity asset classes like large buyouts, small buyouts, and growth equity. And finally, the portfolios are diversified by vintage year. Then we turn to manager selection, where we're trying to choose private equity firms that can generate significant outperformance compared to their peers. In private equity, the dispersion of performance between top-performing and bottom-performing managers is very high compared to other asset classes. So this is an important ability for Fidelity to add value to client portfolios. So we're using a set of proprietary tools that include both quantitative and qualitative tools to choose which managers we believe will outperform. In those, we're also looking for managers who have durable franchises, stable teams, and long track records. And then we're looking for those firms that can outperform their peers, looking for what their competitive advantages are. For example, firms with industry expertise or advantage sourcing. And finally, we're doing significant operational due diligence on those firms before we invest.